Silver just triggered a global market shock that erased confidence in minutes. If you were watching the screens, you saw it happen in real time.
If you're watching this right now, you're probably asking the same question everyone else is asking. What just happened, and why did it happen so fast? That question matters more than the price itself, because the answer determines what comes next. Now here's where it gets interesting. This wasn't just a silver story. This move sent shockwaves through leveraged funds, derivatives desks, and physical supply chains at the same time. When silver moves like this, it exposes pressure points across the entire financial system, but this is only the surface. The real story starts underneath the price action, where a trap had been quietly forming long before today. And once silver hit it, the reaction was inevitable. But this is the part nobody's talking about, and it changes how you should interpret everything that follows. Why this matters now. This matters now because this move did not stay contained inside silver. Within hours, liquidity tightened across related markets. Leveraged positions were forced to unwind. Volatility spiked where it wasn't supposed to. When one asset triggers forced selling, it reveals where leverage is hiding, and silver just exposed it. Here's the number you need to anchor on. Over the last 12 months, silver had already moved more than 200% from its lows. That kind of move attracts fast money, crowded trades, and fragile positioning. When price hits the wrong level under those conditions, exits disappear instantly. If you're watching this thinking, this is just noise, understand this. Events like this don't just reset price. They reset behavior. They change how banks manage risk, how exchanges adjust rules, and how physical buyers respond. That's why the timing matters more than the percentage drop. This also matters because of where we are in the broader cycle. Debt levels are extreme. Liquidity is uneven. Trust in paper markets is already thin. A violent silver move acts like a stress test. It shows you what breaks first when pressure rises. And if you're holding exposure, directly or indirectly, this is no longer about whether silver goes up or down tomorrow. It's about whether the system supporting that price can absorb stress without cascading failures. Here's the mistake most people make. They focus on the chart and ignore the context. They treat this like a standalone event instead of a signal. But signals like this usually arrive before larger adjustments, not after them. Now here's where it gets interesting. To understand why this mattered so much, you first need to understand a simple mechanism that almost nobody outside professional trading ever talks about. And once you see it, today's move stops looking mysterious and starts looking inevitable. But this is the part nobody's talking about, and it's exactly where the trap was set. The trap mechanism. To understand what happened, you need to understand one simple concept that controls markets when they get crowded: thresholds. Think of the market like a high-rise building with weight limits on each floor. As long as the weight stays under the limit, everything feels stable. People keep piling in because nothing breaks. But once that limit is crossed, the floor doesn't bend slowly. It gives way all at once. In markets, those limits are not visible signs. They are price levels where leverage, psychology, and rules collide. Silver hit one of those levels. Here's the mechanism. When price approaches a historically significant zone, traders don't just buy or sell, they layer positions. Funds add leverage, short sellers stack protection, algorithms tighten triggers. The entire structure becomes rigid. It looks strong, but it's actually brittle. If you're watching this and thinking this sounds abstract, anchor it to a number. Silver approached a level it had not sustained in decades. That alone guaranteed aggressive positioning on both sides. Long traders expected a breakout, short traders expected rejection. Both sides used leverage. This is why these zones are dangerous. They concentrate risk. Now here's where it gets serious. Once price touched that level and failed to push through decisively, the first layer of stops triggered. That selling pushed price lower just enough to trigger the second layer, then the third. This is not panic. This is automation. Picture a row of dominoes placed inches apart. One falls, and the rest follow instantly. That's how liquidation cascades work. And this is why silver didn't drift down. It snapped hard. But here's the part nobody's talking about. That technical trap alone was not enough to cause the magnitude of the move you saw. It was the spark, not the fuel. The fuel was already sitting underneath the market waiting for a trigger. And once the trap was sprung, that fuel ignited immediately. Let me connect the dots, because this is where most explanations stop short and get it wrong. The primary cause. The primary cause was forced liquidation. Once that threshold broke, leverage turned from a weapon into a liability. Traders who thought they controlled large positions with relatively small capital suddenly found themselves under pressure. And when pressure hits leveraged positions, there is no debate and no delay. Positions are closed automatically. Here's the number that matters. In highly leveraged silver instruments, a move of just 8 to 10% is enough to wipe out an entire position. Silver moved beyond that range in a fraction of the trading session. That means margin calls didn't arrive politely. They arrived all at once. If you're watching this and you've never traded on margin, understand this clearly. When margin requirements are breached, you don't get a choice. You don't get to wait for a bounce. The system sells for you. Now here's where it gets interesting. This liquidation did not come from one group. It came from multiple layers at the same time. Retail traders using leverage, hedge funds running momentum strategies, systematic funds reacting to volatility thresholds. All of them were forced to do the same thing simultaneously. Selling begets selling. That selling pushed price lower, which triggered additional margin calls, which triggered more selling. This is the feedback loop that turns a pullback into a crash. Not emotion, not fear. Mechanics. And if you're wondering why gold didn't follow silver down the same way, this is your answer. Gold did not have the same concentration of leverage at that exact level. Silver did. That difference mattered. But this still doesn't explain why the move accelerated when it did. Liquidations explain the speed, but not the timing. For that, you have to look at what changed just before the move began. But this is the part nobody's talking about, and it's the secondary force that turned stress into a full breakdown. The secondary cause. The secondary cause was a rule-based squeeze tightening at the worst possible moment. Right before silver hit that threshold, the cost of holding risk changed. Margin requirements rose. Risk controls tightened. Liquidity providers stepped back. These are quiet shifts, but they matter more than headlines. They determine how much pressure the system can absorb before it breaks. If you're watching this closely, here's the number to focus on. When margin requirements rise by double digits, effective leverage collapses instantly. A position that looked safe yesterday becomes unsustainable today. That forces traders to reduce exposure before price even moves. Now here's where it gets interesting. Those changes don't happen in isolation. They arrive when volatility is already elevated. That timing is critical. It means traders are asked to post more collateral at the exact moment prices are moving against them. This creates a squeeze from both sides. Price falls, increasing losses. Requirements rise, increasing capital demands. The only release valve is selling. And this changes everything, because once forced selling starts under those conditions, liquidity vanishes. Bids pull back, spreads widen, small orders move price more than they should. The market becomes fragile. If you're watching this and thinking this sounds technical, simplify it. Imagine a crowded theater where exits suddenly narrow while the lights go out. People don't move calmly, they rush. And the rush causes the damage. That's what happened here. But this still isn't the full picture. These mechanics have shown up before. Not once, not twice. Repeatedly. And every time they appear together at key levels, the outcome rhymes with history. Let me connect the dots because this exact setup has appeared before, and the aftermath tells you what this move likely represents. The historical rhyme. This is not the first time silver has behaved like this, and that's the point. When silver reaches levels that compress years of speculation into months, the market doesn't resolve gently. It releases pressure violently. You've seen this pattern before. even if you didn't recognize it at the time. Think back to prior major silver peaks. Each one shared the same structure: rapid price acceleration, crowded positioning, rising leverage, rule changes, or liquidity shifts. Then a sudden brutal reversal that convinced most people the move was over. Here's the number that matters. In past cycles, silver has experienced corrections of 25 to 40% inside broader bull trends. Not at the end, in the middle. These drops felt terminal while they were happening. In hindsight, they were structural resets. Now here's where it gets interesting. Each time this happened, the narrative flipped instantly. Headlines went from inevitability to disbelief. The same people who chased the move up declared it finished on the way down. That psychological reversal is part of the cycle. This is why today feels familiar. Not because history repeats perfectly, but because behavior does. Leverage builds the same way. Fear unwinds the same way. And markets punish the same mistakes. If you're watching this and thinking this time feels different, understand this. Every cycle feels different when you're inside it. That's what makes it effective at transferring risk from impatient hands to patient ones. But history alone doesn't tell you whether this move was a reset or a reversal. For that, you need to weigh the arguments on both sides, and that's where most people lose clarity. Now here's where it gets serious. There is a bearish case that deserves to be heard, and there is a bullish case that refuses to go away. Which one dominates determines what comes next, and this is where the real tension begins. The bull versus bear case. The bearish case is simple, and it sounds convincing. Silver moved too far, too fast. A multi-100% move in a compressed window attracts speculation, not stability. When trades get crowded, they unwind violently. From this view, the crash was not an accident. It was the market restoring balance. Excess leverage flushed out, momentum broken, trend exhausted. Here's the number bears point to. After similar vertical runs in past cycles, silver did not recover immediately. It spent months, sometimes years, rebuilding confidence. From that perspective, this move marks the beginning of a longer cooling period. That argument deserves respect. But here's the mistake most people make. They stop there. Now let me connect the dots, because the bullish case is not based on hope or sentiment. It's based on confirmation signals that did not break during the crash. Here's the key contrast. Paper price collapsed quickly. Physical behavior did not. When markets truly roll over, demand weakens everywhere. That didn't happen. Premiums stayed elevated. Deliveries continued. Stress did not disappear. It shifted. And this changes everything. If you're watching this closely, here's the number that matters. During the sell-off, the price moved violently, but availability did not suddenly improve. Supply didn't flood back. Inventories didn't surge. The underlying pressure stayed in place. This is what separates a reset from a reversal. In reversals, the reason for the move disappears. In resets, it remains. Now here's where it gets interesting. Resets feel worse than reversals in the moment because they attack confidence instead of fundamentals. They are designed to make you question the entire thesis right before the next phase begins. But that doesn't mean risk disappears. Volatility remains. Further downside remains possible. Anyone pretending otherwise is ignoring history. Which brings us to the only question that matters now. Not what happened yesterday, but what confirms the answer going forward. And that's what you need to be watching next. Confirmation, posture, and the decision point. Here's what confirms whether this was a reset or something more dangerous. First, watch how price behaves around the level it just broke. Violent moves that immediately stabilize signal exhaustion, not collapse. If price begins to consolidate instead of free-falling, it tells you forced selling has largely run its course. Second, watch availability, not headlines. When a real top forms, access improves, supply loosens, stress fades. If access stays tight while price whipsaws, pressure is still present beneath the surface. Third, watch how volatility behaves. Sustained volatility after a crash means positioning is still being rebuilt. Calm after chaos usually comes later, not immediately. If you're watching this wondering what I'm doing, understand this clearly. This is not advice. This is posture. I am not chasing. I am not panicking. I am watching behavior, not predictions. I am looking for confirmation, not conviction. Now here's where it gets interesting. There are 3 types of people watching this right now. The first is already convinced it's over. You saw the drop and mentally checked out. You want distance from the pain. The second is frozen. You don't know whether this was an opportunity or a warning, so you do nothing and wait for certainty that never arrives. The third understands that moments like this are inflection points, not because the price is clear, but because the structure is. Which one you are determines how you experience the next phase. Let me be clear about the thesis. This was not random. This was not chaos. Silver hit a structural trap built by leverage, thresholds, and tightened rules. The reaction was violent because the system was fragile at that level. That does not mean the broader forces disappeared. It means they were tested. This moment matters because these resets do not show up often. When they do, they reveal who understands structure and who reacts to noise. History remembers these moments as turning points, not because they felt good, but because they changed trajectories. If this helped you see the move differently, don't keep it to yourself. Share this with one person who is still confused by what just happened. Drop a comment so I know you're paying attention. Subscribe if you want analysis that focuses on structure instead of headlines. Stay calm, stay patient, stay aware. This market just showed its hand, and one more thing before you go. The real tell won't be the next big candle. It will be the quiet days that follow. When price stops making sense to those looking for drama, that's when structure starts to reassert itself. Watch those days closely. They decide what comes next.